Let us now move on to redemption of preference shares. For redemption of preference shares, the issue will be about determining whether redeemable preference shares is an equity or a liability. The treatment for redemptions of preference shares will be guided by Part 3, Division 1, Subdivision 1 of the Companies Act 2016. As mentioned earlier, the issue underlying preference shares and redeemable preference shares is classification. Should it be classified as equity just because it is a share, or should it be classified as liability since it acts like a liability? We have learned in the earlier course that the key feature of liability is having a present obligation that need to be settled by an outflow of resources, such as cash or other financial assets. In contrast, an equity, the main feature is having a residual interest in an entity's assets after considering its liabilities. Now the classification looks clear, but we need to understand the nature of the classification and its potential effects before we can be very certain of the classifications of an instrument. Liability normally results in payments treated as interest and charged to earnings, while any financial instrument will be considered as equity if it does not have contractual obligation to deliver cash or other financial assets, and if the instrument will or may be settled in the issuer's own equity instruments. So for ordinary shares, where all the payments of dividends is at the discretion of the issuer, it is classified as equity of the issuer. However, for preference shares that are required to be converted into ordinary shares, will it be classified as equity? Here, we need to consider whether there is a variability in either number of equity shares delivered or variability in the amount of cash or financial assets received before we decide on the classification. If the contract need to be settled by delivering fixed number of own equity for fixed amounts of cash or another financial asset, it should be classified as an equity. However, if the contract requires settlement by delivering variable amounts of own equity or cash or another financial asset, it should be classified as a liability. So if a contract requires an entity to deliver as many equity instruments as are equal value to a certain amount, the holder of the contract is indifferent whether it receives cash or shares to the value of that amount. Therefore, such contract will be considered a debt. The correct classifications of financial instruments as either a liability or an equity is important, as it has significant impact on entities' gearing ratio, reported earnings, and debt covenants. Gearing ratio, as you already discussed in previous course, is the calculations of long-term liabilities against an entity's capital. So the classifications of an instrument as either equity or liability will determine whether the gearing ratio is higher or lower. And this, in turn, can affect the debt covenants, the agreement between a company and its creditors on the level of debts that the company should have at a certain point in time. Other factors that could help to determine the classification of instruments as debt, specifically for redeemable preference shares, is by determining whether the redemption is at the options of the holder, is there a limited life to the instrument, is redemption by future event that is beyond the control of both holder and issuer, and are dividends non-discretionary? If the answer to these questions is yes, then the instrument should be classified as a debt or liability. Factors that may help to determine the classifications of instruments as equity is to determine whether the shares is non-redeemable, or if there is no liquidation date, or are dividends discretionary. If the answer to these questions is yes, then the instrument should be classified as equity. In determining the classifications of redeemable preference shares, we need to apply the principle of substance over form, meaning we need to really consider how an instrument behaves, that is the substance of the instrument, and not simply tied to the form of the instrument. Basically, we are saying that just because preference shares is a share, it does not necessarily behave like one. The substance reflects the underlying realities of a debt in terms of accounting transactions. For redeemable preference shares, we need to look at whether the redemption is mandatory to determine whether it should be a liability. For convertible bonds, it has both elements of equity and liability. Thus, an entity needs to determine portions of liability and portions of equity. This is the summary of the terms of preference shares that need to be assessed to determine the classifications of preference shares. We need to assess two things: the redemptions of the principal amount and the payments of dividends. If the preference shares is non-redeemable, we need to assess the payments of dividends. If it is discretionary, then it should be classified as equity. If the preference shares is redeemable, but it is at the discretion of issuer, then the assessment will be similar to the non-redeemable preference shares. If the preference shares is mandatory or is redeemable at the discretion of the holder, then the shares must be a liability. Assessments of dividends will, however, determine whether the entire amount should be recognized as liability or there exists a portion that should be recognized as equity. Redemptions of preference shares is recognized in the Companies Act and should be treated with guidance in Section 72. In Section 72, subsection 3 states that a redemption of preference shares is not considered as reduction in capital, thus the amount redeemed must be replaced. Subsection 4 states that redemption can be done using funds from profits or from issuing new shares or from capital of the company, which is not very clear in practice, as if it is saying, take the capital out from capital account and transfer it back to capital account. However, subsection 5 says that if we do not use funds from issuing new shares, then we must use retained profit to replace the redeemed capital. Let us now look at this illustration. Here, SMN Berhad has issued 400 units of redeemable preference shares at 120 ringgit per share. We are required to show the journal entries and how it is presented in the statement of financial position. Now, if the redemption is mandatory at the hand of shareholders, for journal entry, we debit bank to recognize the receipts of cash and credit redeemable preference shares to recognize a liability. In the statement of financial position, it will appear under non-current liability. If the redemption is at the discretion of the issuer, the journal entry will be the same, but when we recognize redeemable preference shares, it will be an equity. Thus, in the statement of financial position, it will appear under equity instead. Now let's look at the redemptions of the redeemable preference shares. Say that the redeemable preference shares was recognized as equity and SMN Berhad has decided to redeem all of the shares at 145 ringgit per share. We need to show the journal entries if the redemption was made out of issuance of new ordinary shares at 2 ringgit and 50 cents, or out of profit, or out of capital as prescribed by Section 72, subsection 4. To redeem out of new issue of shares, the effect is 2. 1. Redeem the shares, thus eliminating the shares. 2. At the same time, we also replace the eliminated shares with new shares. So the journal entries will be debit bank to recognize the receipt of cash from issue of new shares, credit ordinary shares capital to recognize the shares. Then we debit redeemable preference shares account to eliminate the shares, credit cash with the amount paid, and debit retained earnings for the difference. The amount of capital before the redemption was at 68,000 and after the redemptions is at 70,000. Thus, there is no reduction in capital. The eliminated shares have been replaced by the new shares. If we redeem out of profit, we debit redeemable preference shares account to eliminate the shares, credit cash to record the payment made, and debit retained earnings with the difference. Then we need to replace the eliminated shares. Thus, we debit retained earnings and credit share capital with the amount eliminated. Therefore, the total capital before the redemption was at 68,000 and remains at 68,000 after the redemption. If we redeem out of capital, we do the same for redemption and replace the share with capital, which in this case does not make sense. So a more practical way of doing it is by transferring the amounts needed from retained earnings. Therefore, the capital before and after remain the same. And if the reduction of capital is allowed, we can just ignore this step. Now what if the redeemable preference shares was recognized as a liability instead? For this scenario, the company decided to redeem the preference shares at the end of its 5th year at 3 different prices. First at 145 ringgit per share, second at 120 ringgit per share, and third at 110 ringgit per share. The preference share bear a fixed dividend of 5% or 2,400 ringgit a year. We need to show the journal entries at issue date, at the end of every year, and at redemption date using straight line method. Now remember, in our last discussions on financial liability, straight line method is not commendable, but we use it in this illustration to make it simple, as the way we record it or the journal entries will still be the same. Only the value will be different if you were to apply effective rate method. Before we do the journal entries, I want you to understand two things. First, since the preference shares is recognized as liability, thus the dividend payment will be treated like interest, and this amount of interest will affect the value of the liability. Second, at redemption, there will be 3 different values to redeem for the 3 different prices. We know that for financial liability, the balance will be either increased or decreased to get to the amount at the end of the period agreed. Similarly here, since the amount at issue is different from the amount at redemption for 2 of the prices, we need to increase the amount from 48,000 to 58,000 for price 1 and reduce the amount from 48,000 to 44,000 for price 2. We can do this using straight line method, that is dividing the difference by the number of years. So for price 1, which is higher than the issue price, we need to increase the balance by 2,000 ringgit every time we pay the dividend. And for price 3, which is lower than the issue price, we will need to reduce the balance by 800 ringgit every time we pay the dividend. So at issue date, we will debit bank to recognize the receipt of cash and credit redeemable preference share with the same amount. Every end of year, for price 1, we will debit interest expense account with 4,400 and credit bank accounts with 2,400, the fixed amounts for dividend. For price number 2, no difference between amount at issue date and at redemption, thus we debit interest expense with the same amount paid as dividend. And for price 3, we debit interest expense at a lower amount than the dividend at 1,600 since we need to reduce the balance in the preference share account by 800. At redemption date, by this time, the balance in preference shares account will be as required. We simply debit the redeemable preference shares account and credit bank with the amount redeemed. Note that since for this case the redeemable preference shares was recognized as liability, thus there is no reduction in capital due to the redemption, thus there is no need for us to replace the eliminated liability. So that is all about share buybacks and redemptions of preference shares. This will also be our last video presentation for this course. As usual, please replay this video if you think you missed anything. Thanks very much for your attention, and wassalamu alaikum warahmatullahi wabarakatuh.